Okay, in this video, I'm just going to be taking you through how to answer a whole range of different questions. So it's not necessarily all related to the one topic, all monetary policy questions, but from a broad range of things what we've talked about for the last couple of weeks. So firstly, the question is, explain how monetary policy settings in recent times have contributed to the housing price boom. In your answer, refer to one transmission mechanism. Okay, so what you need to be able to do in this question is explain, firstly, what's happened to the monetary policy stance, how that's affected commercial interest rates, flow that through to a channel, and therefore use it to explain what's happened to property prices. So the RBA has lowered the cash rate on 2 occasions this year, from 1.5 to 1.25% in June, and then down to 1%. Sorry, that should be 1.25 down to 1% in July. This has reflected a more expansionary or accommodative stance, and interest rates have remained at record lows. This has then led to a drop in commercial interest rates across the economy, and basically what that has done is stimulated the demand for housing. So the lower interest rates have increased the demand for housing because people know there's lower mortgage rates, and basically that's increased the availability of credit. So this answer is actually talking about the availability of credit channel as opposed to the savings and investment channel. So lower interest rates have made it easier for borrowers to get loans or meet the requirements of lenders, which has resulted in more loans being approved. This has led to increased demand and therefore higher housing prices. Along with the cost of credit being lower, this led to significantly higher house prices in Sydney and Melbourne. This has made it particularly difficult for young borrowers to purchase property. Now be careful, just be mindful of this question. This isn't really what's actually happened. House prices have gone down this year. This is just showing hypothetically what lower interest rates can do to houses, but it's actually not true in relation to the current. Because we know that interest rates are not having the desired effect on borrowing. Second question, explain how the RBA loosens monetary policy in response to very weak economic conditions. So that's the question, asks you how. This is the question we did in class from the CPAP guide. Basically, this question is about how the RBA loosens monetary policy. It's not about why they did it. So first thing they do, they will announce a lower target cash rate and then enter the overnight cash rate market to increase liquidity to give the banks cash to make sure that the actual cash rate is close as possible to the target. That language is really important. They want to make the actual cash rate as close as possible to the target cash rate. This increases liquidity because the banks purchase government securities in the cash market. It increases liquidity by purchasing government securities off the banks in the cash market. Financial institutions then sell securities because the RBA offers them a high price, so they sell them at a high price. The supply of cash is therefore increased, which reduces down the cash rate. The RBA will stop securities once the actual cash rate is close as possible to the target, and then it will manipulate the supply of cash on a daily basis to make sure they stay close. It's important to include this step because that's what they do on a regular basis. The lower cash rate then helps to stimulate other interest rates in the economy or lower other interest rates, which should fall by a similar amount and therefore boost demand, real GDP, and improve economic conditions. Under what circumstance would the RBA increase interest rates if the inflation rate is within the target range? So it's between 2 to 3%. Basically, as we know, they act preemptively, so they would do this when they anticipate that inflation is likely to be above 3% in the future. So they look at a range of leading indicators to get an idea of what inflation is likely to do in the future. So that might be strong consumer confidence, a high number of building approvals or loan approvals, lots of credit growth, and they'll look at all these factors to see what inflation is likely to be in the future and use that to determine their monetary policy stance. So it's all about looking at leading indicators and being preemptive. Explain how a tightening of monetary policy could help to reduce inflation, make reference to inflationary expectations. So basically, a tightening of monetary policy can help reduce inflation for many reasons. So the first thing we're talking about is just the general reasons. So it can reduce discretionary incomes and lead to less spending. It can reduce the incentive to borrow and therefore reduce demand pull inflation. They can also appreciate the dollar, which reduces the price of imports in production, as well as decreasing demand for local exports, which reduces inflation. And lastly, they can help to reduce inflation through inflationary expectations. So what essentially happens is they know the RBA is going to increase interest rates. They know inflation is going to be under control. So consumers, producers, the government know that inflation is under control, and they're less likely to spend in the short term, and they're also less likely to demand higher wages. And that in itself helps to keep inflation under control. What is meant by open mouth operations and how it impacts economic activity? Open mouth operations refers to the fact that the RBA does not need to actually change the cash rate to have an impact on consumers and producers or businesses. Just by hinting or announcing they're going to increase interest rates, that's enough to make spending fall. So when the RBA announced the cash rate is increasing, banks are likely to increase interest rates. This leads to businesses becoming more likely to delay investment, and consumers will often constrain spending due to fears of higher borrowing costs. And this reduction in consumption and investment helps to reduce aggregate demand and economic activity. So that idea that just by hinting they're going to increase interest rates people reduce their spending because they're worried about inflation. So they're less worried about inflation occurring, and therefore that helps to keep inflation under control as well. Why does the RBA need to be preemptive or forward-looking when determining their monetary policy stance? They must be preemptive in their use of monetary policy because it can take a significant amount of time for the transmission mechanisms to work to their full capacity. So it can take up to 2 years for changes in the cash rate to flow through to have their impact on consumption and investment. The RBA must be forward-looking and stop to inflation occurring before it actually occurs. So they will look at a range of different statistics or indicators to determine what is likely to happen to inflation in the future. So if signs that there's like strong consumer confidence, high levels of business approvals, lots of inflationary pressures in the economy, then they're likely to increase the cash rate to prevent inflation pushing outside the target range. So they have to be preemptive because it can take up to 2 years to have a desired effect. So they look at a range of indicators to see what's going to happen to inflation in the future and make their call based on that data. In terms of difference between lagging and leading indicators, basically leading indicators are more useful because they tell us what's going to happen in the future. So leading indicators provide indication of what is likely to happen to economic growth or inflation in the future. And some examples would be loan approvals, business and consumer confidence, growth rates overseas. Whereas lagging indicators are different and they provide indication of what has already happened in the economy rather than what is likely to happen in the future. So examples would be like the unemployment rate and inflation. So leading indicators are more relevant to the RBA because they give the board an indication of the likely future inflationary pressures in the economy, which is more relevant in determining their stance because we're trying to be preemptive and catch inflation before it occurs. So leading indicators, better indication of what's going to happen in the future and therefore used more regularly by the RBA. Explain why the preemptive nature of monetary policy can result in poor decision making. Well, basically, because they're being preemptive, they're kind of taking a guess at what's going to happen in the future. So as we know, the transmission mechanisms can take up to 2 years to have their effect on consumption and investment. So the RBA is forward-looking, and this can lead to poor decision making because they anticipate future inflationary pressures, and then something happens or emerges that they don't think. So they may tighten monetary policy, and then unforeseen circumstances like weak overseas growth, a natural disaster, the GFC, may then reduce inflation and growth in the economy, and they wish they didn't tighten monetary policy. So the monetary policy can act in a pro-cyclical fashion and slow the economy down even further than what the GFC did. Okay, so they're making guesses at what's going to happen in the future, calculated guesses, but that's not always what happens, and therefore they can often get it wrong. Discuss the effectiveness of monetary policy as a weapon to fight imported inflation. Monetary policy can be very effective in fighting imported inflation. A tightening of monetary policy will help appreciate the dollar. So when we have a tightening of monetary policy, the dollar often appreciates. That increases the purchasing power of the Australian dollar and reduces the cost of imports. So essentially that helps to reduce the price of intermediate products in production, so your cost of production. Higher interest rates also reduce demand for imports due to Australia's having low discretionary income. So basically what I'm saying is that we can reduce imported inflation, one, because the dollar gets higher when we tighten monetary policy. That makes imports cheaper. Secondly, when we tighten monetary policy, people have less money and therefore they're less likely to buy imports. So the demand for imports goes down, and that essentially helps to reduce the price as well. Kind of depends on how big a market Australia is for that importer. So for example, if we are their main buyer and we say buy 80% of their products, then a reduction in demand for Australia would have an impact on price. But if we're only like a minor part of their industry, then there's probably not going to have a big impact. Okay. How does a tightening of monetary policy affect full employment? Again, a tightening of monetary policy is likely to have negative implications on the goal in the short term. There'll be more cyclical unemployment and may lead to unemployment above 5%. It's because higher interest rates reduce discretionary incomes and the amount of spending in the economy. It can also appreciate the dollar, which reduces the incentive for people to go into debt and reduces consumption and export demand. It reduces aggregate demand and growth and causes job losses in many industries. So a tightening of monetary policy can be bad for full employment in the short term. Having said that, in the long term, if a tightening of monetary policy helps to keep inflation within the target range, it makes us more internationally competitive, it promotes demand for our exports and creates jobs in Australia. So you really need to take a short and long-term approach to this. Short term, it has a negative impact through the channels, but in the long term, if we can contain inflation, then yes, we can maintain competitiveness and we can increase employment in the economy. I'm going to skip forward just to this question here. Explain how monetary policy can help to improve economic growth, employment, and living standards. So it's really important you understand that an expansionary stance is good for economic growth, employment, and living standards in the short term, but potentially can have negative implications in the long term if it causes inflation. So if you look at this question in terms of how a loosening of monetary policy impacts living standards, in the short term, you want to be talking about all the benefits. So those with variable rate loans have more discretionary income and therefore more purchasing power. Consumers and businesses are often more willing to borrow. So because of the lower cost of credit, that helps to boost consumption and investment spending, which flows on to increase demand for Australian goods and services and boost the derived demand for labour. And as we know, the more labour, the more employment in the economy, the more people that are earning an income or a factor income, which boosts their purchasing power, which is important to recognise when you're talking about living standards. And also, when more people are getting a job, it reduces incidence of things like crime, social isolation, and depression. There's always that link to non-material living standards, which is quite prevalent whenever you're talking about unemployment going down as well. So key links, anyone with a loan benefits because they've got more discretionary income, and you also want to make the links to consumption and investment flowing through to increased employment, and therefore more jobs and more income throughout the economy as well. Unfortunately, in the long term, an expansionary stance can have negative implications, and that's because it can lead to inflationary pressures. It can which reduces people's purchasing power. It can also reduce our international competitiveness if there's too much inflation, which leads to job losses and potentially more unemployment and worse non-material living standards and material living standards. A tightening is obviously the opposite. It hurts in the short term because those with loans have less discretionary income, less people borrow, less people spend, less businesses spend. It reduces demand and therefore the demand for labour. Less labour resources needed means less incomes, more unemployment, more people earning transfer income, reducing purchasing power and also increasing crime, social isolation and depression. In the long term, by limiting those inflationary pressures, it can create an environment that stimulates growth and employment. So if we can keep inflation down, it boosts purchasing power, boosts international competitiveness, creates jobs in the tradable sector, and hopefully reduces unemployment and promotes our living standards. So there is a bit of a trade-off in terms of short and long term, and that's why inflation is such a big goal for the Australian economy.